Welcome back, everyone. Michael here with Offshore Citizen. Often we are talking on this channel about, well, international things, and this includes various different countries. Now, in practice, I actually think the whole point is not about going abroad or doing something abroad or planting flags in multiple countries, etc. Rather, it is about picking and choosing the best from each country and combining it together. So in other words, your overall outcome can be better when you're willing to take a bit from here and a bit from here and combine them together. Now, one of those areas potentially is investing. And specifically today, I'm going to talk about real estate investing and the disadvantages associated with quote unquote foreign real estate investing. So some things to be aware of that could hurt your returns and possibly have some other negative consequences that you should be aware of before you go into that situation. So we're going to talk about it today. Before we do, if you haven't already, please hit the subscribe button, hit the all notification bell. If you'd like assistance with international investing, international tax optimization, relocating abroad, getting residency, citizenship, setting up international structures, asset protection, etc., please reach out to me. You can book a call, calendly.com/Michael-Rosmer. There's a link in the description below, or send a message to our websites, offshorecitizen.net and offshorecapitalist.com. All right, so the idea here is when you're kind of jumping into real estate, what is the objective? I mean, conceivably, there could be some asset protection diversification side, there could be a life side, and there could be a risk reward side. In other words, you want to produce a return on your money. Now, obviously, you can go and invest in other markets, and by doing that, you can get some diversification, which kind of takes you away from the exposure in any one market. That's perfectly legitimate. Also, if you want to go and live in multiple places at once, which I think is great, then certainly buying property in those places in order to benefit from being able to live there is also great. If it turns out you can also get a return, maybe you Airbnb out your place while you're gone or something, great, whatever. If you want to leave it just for you, also good. However, then we come to the investing part of it. And I think what happens in a lot of areas is they pitch foreign as better. Now, don't get me wrong. Sometimes foreign is better. The yields that you're going to get in a bunch of markets are quite poor, and even the upside in some markets could be quite poor. This being said, there are some notable disadvantages when entering into a foreign market that you may or may not have in your local market. Now, it does depend where your local market is and where the foreign market is. However, let's talk about these. And the starting point is to understand that arguably a lot of the value in real estate, the returns that is, actually don't come from the real estate, they come from the financing. So if you just consider that on average, a normal, reasonable purchase probably will yield you, if you're actually doing a good job of buying fairly well, etc., maybe 8% a year, 7% a year. I would say kind of 7 to 12 is that range. So, okay, maybe you can go someplace where you can get 12% return. I was actually talking to some people, kind of 12 to 14% returns, which are pretty good in one particular market. Not common. You could find those in most parts of the world. Then, however, you might have the opposite, which is some markets that yield 3% or something, and you're sort of in the middle. Now, that in itself is not so attractive. Let's just pick 7% as the number, right? 7%, not a very attractive return. However, if you can borrow money at sub 3% today, depending on the market you're in, you could go maybe as low as 1%. Let's say 2% in a lot of places is not that unreasonable. And so if you can borrow money at 2% and you can make 7% on it, let's say you lever it up 5 times or something, well, now you're making an extra 5% off of the bank's money, which represents the larger share of the invested capital. So the cash on cash return actually can be quite high in that case, right? Now, if you're in a situation where you're in a market where you can't get loans, that's going to be an issue. And generally, it is harder to get loans in foreign markets than it is in existing markets. You can build credit over time. So let's use a simple example. If you were to move to the US, live there, get an ITIN or social security number, build up credit, etc., over time you could get kind of the same access to capital. But your immediate exposure to the market would generally be not great in terms of the access to financing. This would be true in most places that you go. people who are not locals generally have a harder time getting financing. Now, it depends a little bit, are you employed or self-employed? Have you built up credit? What's this credit system like there, et cetera? So it's not easy to generalize this. But just in general, if you're gonna go and you're gonna say, all right, let's pick X country and I wanna go invest there, there's a reasonable chance that as a foreigner, they're not gonna lend you money at all, or if they do, the loan to value will not be as good, the interest rate may not be as good, et cetera, okay? And so this is a definite disadvantage compared to what you can get in your home country. The next is the tax consequences. So tax consequences for real estate in a lot of parts of the world are actually pretty good relative to other types of income. Now, again, varies country to country. For example, Australia and the US have pretty good tax treatment. A few other places, not necessarily so good. But one of the main ways that you can often get better tax treatment in real estate is deferring, and you can do that through refinancing. So we sometimes say that you would buy, build, and sell businesses, whereas real estate you would buy, renovate, and then you would redraw. So you would pull out your equity and go and do something else with it. Well, once again, because financing is weak in a foreign market, you're often not going to be able to gain access to that financing, or it won't be as attractive. Let's just use a quick comparison. Say you go to a country, say you come from a country where you can get, again, 1 to 3% financing, and say you can put a home equity line of credit or something similar on the property, and you can borrow 80% loan to value. It's usually pretty accessible. There's a lot of mortgage facilities, etc. On the other hand, you go to, let's call it a, second world, third world type country. The financial system isn't as robust. There's just not as much in terms of lending facilities. You're a foreigner, so you don't have anything really established there. You buy a property goes up in value. You want to redraw. Well, very often, the interest rate could be quite a bit higher, right? So double, it wouldn't be surprising to see, 5 to 8%, depending on the market, could be higher, could be lower, just depends. And at the same time, your ability to get the same loan to value probably isn't as good. The way they do the valuations might be more difficult. And so as a result, this is an issue. Sometimes in these markets, like if you were in Canada or the US, they have MLS, the multiple listing system, and that really helps to kind of establish what fair market prices are, and therefore there can be lending based on the listing prices on the MLS. You might not get that if you're talking about some of these other countries where it's a very fractured market, right? So bottom line is you may be forced to sell the property in order to pull the value out. And when you do that, usually real estate is taxable locally. So you can't use a foreign company or something like that to slough off the taxes. You're going to pay them locally. Now, sometimes, yes, there are countries where you don't have capital gains, or the capital gains don't apply to real estate, or they don't apply over a certain value, or there's different things like that. But very, very often, you're going to find yourself in a situation where now you lose that deferral value. And when you lose the deferral value, well, that's less money you have to reinvest at the next go round. So anyway, also a significant disadvantage. Not to say, again, there aren't better opportunities in some other countries. There certainly can be. If you're in a market which is very high, which, in a bunch of the world right now, that's the reality, you may be able to find better deals in some other part of the world. And, that might be worth it. And then, you may be willing to build up credit over a long period of time in order to kind of establish yourself well in the market. Those markets, of course, will probably develop over time. Financial markets will become more sophisticated, lending will become more available, etc. But in the meantime, not so great. So I hope it helps. Let me know if you have any questions, put them in the comments below. If there's a place that you think is really interesting for investing in real estate these days, I would love to hear about it. Put it in the comments below. And if you'd like help, again, reach out to us, like the video, share it with your friends. I'm going to see you on the next video.